Bienvenidos a la conferencia anual.
Welcome to the annual conference for economic studies of the Latin American Reserve Fund. This conference has been organized in Cartagena for many years and brought together top-level academics, members of multilateral entities, and a very special group of people, but this year we cannot get together in person, and we have decided to hold a very special webinar instead. Particularly special because we have with us two participants who are really top class. The first one is Dr. Carmen Reinhardt, very well known, I'm sure, by all of the people connected. She is the Vice President and Chief Economist of the World Bank. Previously, she studied at Harvard, at the Kennedy School of Harvard. She has huge amount of experience, many publications, and she is a great source of advice. We consult her in the economic world, within the academic side, as well as amongst policymakers. Dr. Carmen has a particular characteristic, combining economic theory with the observation of data and understanding of data and economic history. And this has taken her, or turned her into a person who must be consulted whenever we are looking at emerging economies. And the second participant is Dr. Liliana Rojas Suarez, currently the director of the Latin American Initiative and senior fellow at the Center for Global Development. She is also very well known in our region and a great source of knowledge, and she has been for a long time now. She is linked to Columbia University. She's a president of the Latin American Committee on Financial Issues, FLAR. She has experience in the multilaterals with different positions in the Monetary Fund and the Inter-American Development Bank. So we have two exceptional people with us to talk about a fundamental issue. So we're going to be talking about the impact of COVID. We've decided to focus on financial fragility in Latin America, which may have been caused or exacerbated by COVID-19. So I don't want to say anything more. I would rather leave this time for our two guest speakers to be able to really make the most of this opportunity. I'm sure it will be of great use for the people who are listening, and it will be available after the transmission. So, like I said, I would like to give them the floor straight away. First of all, to Dr. Carmen Reinhardt. You have the floor. Thank you very much. It's a pleasure to participate, although we're not in beautiful Cartagena, where we have met on other occasions, but I hope that we'll be able to meet in the future there. As you can imagine, given the subject of this webinar, I'm going to talk about fragility in Latin America, in particular, and at a global level, in more general terms as well. First of all, I would like to talk a little bit about the historical pattern of financial crises. I'm not doing this out of academic curiosity, but rather in order to be able to compare the current situation, in which ways it is the same and in which ways it is different to the historical patterns. The banking crisis, in the case of Colombia, in 98, for example, well, in general, before crises, there is a long period of growth, and during that period of growth, there is a lot of optimism, and growth and optimism are combined, and this leads to greater borrowing. People in their homes, individuals, and at a corporate level take on more debt. So this mixture of growth, optimism, and the growth based on a growth of credit and debt tends to create bubbles in the real estate sector, in the stock market. So we're talking about a boom until it comes to an end. The change might come from some kind of shock. Maybe commodities prices drop, like Guillermo Calvo talks about, the stop in capital flows, or whatever the reason might be, a political situation. But there is something which stops the growth, and given that there has been a prior growth in borrowing at a private or a corporate level, this means that there is a growth in the defaulters with financial problems, which aggravate even more the recession. The recession leads to companies and homes having problems in paying back their debt, and the crisis is further deepened. And this leads to a credit crunch. If we talk about homes and companies, they don't want to take on more debt because they're trying to reduce the debt that they acquired in the previous period. And on the side of the banks, they realize that they gave loans which were not often very cautious or very wise. So they take further measures to improve the quality of the credit portfolio. And all of this combines to lead to a credit crunch. I think, my dear colleague and friend Liliana, well, I think we both find ourselves in a similar viewpoint if we say that there is great fragility in Latin America, but also at the global level in advanced countries, the more middle income countries and the emerging countries. So we're talking about a systemic problem at a global level, this problem of fragility. So I made this comparison because right now, well, the process that I have described is called boom bust. You have a bust after a boom. In Latin America, as you all know, the boom was at the start of the 2000s, but it stopped when the commodities prices fell. The taper tantrum in 2013. So as of 2014, 2015, we saw a slowdown, a considerable economic slowdown. This coincides with lower commodity prices, the arrival of capital, which had been very strong and begins to have ups and downs. Given that there is growth, or lower growth, sorry, and the prices of the exports of commodities, these prices are lower, so debt accumulates simply because the countries are trying to maintain their growth levels within a global setting which is not very favorable, even though the interest rates at a global level were very low. So in this setting, we see the arrival of COVID. It finds the region's countries. Well, if we took a snapshot of the situation of the countries at the start of this year and you compare it with the situation of those same countries in 2008 when the crisis exploded, the subprime crisis exploded in Europe and in the United States. The comparison is not favorable. The countries are much weaker at the start of this year than they were in 2008. And in 2008, the crisis, well, it was quite brief. There was financial turmoil, but the crisis in 2008, 2009, they called it a global crisis, but it was a crisis in 11 advanced economies that had a problem in their real estate market with excessive borrowing linked to that market. But this time we really are talking about a global crisis. And if we look at the recovery in 2008, 2009, it was very fast and boosted by the growth of China that was growing over 10% per year and the strength of the prices of commodities. But that's not the same situation today. So the starting point was weaker at the start of this year, and the scale, the size of the shock of COVID, we have drops in GDP this year. Well, if you want to find anything similar, you have to look at times of war. They are really, off the scale. This combination, and we've been talking about this since February, the fact that this recession was not going to take the shape of a V, but rather an elongated U, this leads to default in the payments by financial institutions because there are homes in which people have lost their jobs and they're not going to find a job quickly. There are restaurants that have closed and they're not going to open again. There are many small businesses, above all in the service sector, which is really suffering with all of this. So this crisis, this financial crisis, or I call it a silent crisis, because we are focusing so much on the health problems, the huge macroeconomic volatility that we have. Well, these problems have been, well, they've perhaps not received very much attention, but they are very important. And these problems have been mitigated because most countries, it's true in Latin America and in other areas, the banks have given payment relief or debt relief to businesses and homes. So this relief is temporary and has helped to hide which part of the portfolio is liquid and which is not for the moment. But I think that when we see what's liquid and what's solvent, when we begin to see this, when these measures follow their course, and when the banks begin to ask for repayments in their portfolio, then I think we are at a time of financial fragility, which is particularly worrying because crises have an impact on the financial sector where corrections have to be made. In order to reduce the burden of the losses on the institution's balance sheets. And these kinds of crises tend to be slower in recovering because one of the driving forces behind recovery and growth is new debt or new loans. So the banks and financial institutions after this situation, a situation which could be considered similar to this one, will end up with greater government debt in their portfolio, more defaulting loans or non-performing loans in their portfolio, and less capacity or appetite to offer new credits. And this credit crunch is very important. It's hugely important in slowing growth. I know that Jose also thinks or would like us to talk about what needs to be done, but I shall leave that for another moment after I finish talking about the initial panorama. Thank you very much, Carmen. I shall now give the floor to Liliana Rojas. Liliana, you have the floor. Thank you very much. Just one moment. I've got it. I'd like to share my screen with you. Before anything else, just like Carmen, the first thing I'd like to say is that indeed I also miss those meetings in Cartagena, and I completely agree with what Carmen said, as on other occasions. And my intention with this presentation is to provide a bit of data and some numbers to follow on from what Carmen has said, because we're definitely on the same page. When COVID begins, if we have to recognize or acknowledge anything as a starting point, despite the macro weaknesses in the region, the financial systems had been relatively strengthened due to the improvement in supervisory quality, independent central banks, and better bank governance. So when capital is measured and compared between different countries, the capital ratios are at levels which are similar to the emerging Asian countries. But COVID comes along and it has highlighted existing vulnerabilities, which Carmen mentioned already, and generated new ones. If we want to know what's happening, basically the dynamics of this pandemic and the kind of policies that are being implemented are what is going to define the stability of the financial system. We all know that banks, well, if we talk about banks, we have to talk about assets and liabilities. And banks are going to be as strong as their customers are, or their debtors, or their counterparties, and the buffers or the reserves that they have to face solvency and liquidity problems. There are many factors that are generating or bringing about new vulnerabilities, which Carmen has already mentioned. I'm going to talk about 4 examples because we don't have time for more. And they are all within the umbrella of uncertainty because we don't know what companies are going to be feasible in the short term or long term, which is the best policy or the best tool for the government to use. All of this uncertainty leads to these factors, which are leading to vulnerabilities. So first of all, as Carmen said, we have the fall in income in families and companies, which obviously brings a problem in terms of a drop in economic activity, which increases credit risk. Here, the graph that we can see is a graph that talks about the GDP per capita at PPP, at constant PPP. We've all seen this figure that we have for these countries in 2020. If we talk about a rebound for 2021, well, what I want to show with this chart is that this rebound is here in 2021. But if we bear in mind the huge drop in 2020, this small upturn, and what this means for Brazil, Mexico, Peru, those kind of countries, we're talking about a loss of a decade or more. We've gone back to the levels of a decade or more ago. The families and above all companies have lost their income, and this means that it's very worrying because corporations that are the customers of the domestic banks, they are seeing an increase in their foreign debt. And the problems in refinancing these operations or these transactions obviously has an impact on the client's quality. If we have debts abroad, then we're going to have problems with our domestic balance sheets, which is what is being studied and evaluated by local banks. And the second point, which Carmen also mentioned, is the regulatory treatment of bank loans, which is the deferral or the postponement of payments. We've seen this throughout the whole region. Here we can see the countries in the region, and they have different models, but in some cases they have allowed these delayed payments or payment holidays. In some cases they've been obligatory, and in some cases they've had restructuring or rescheduling systems. What's important here is that in most countries, no additional provisions have been required. The banks do not have to have additional provisions when they allow for this deferral of payments. What's happening is that the banks in general are reporting these credits, these loans, and these deferrals as if everything was in order. So it's not treated like a default or a delay in payment. And they are not being required to have additional provisions, although I would highlight that some banks are doing that. In my analysis of bank crises, there has been there's no crisis where all of the banks have failed. There are always some that do better than others. So if these payment holidays or deferrals go on for much longer, information is lost. Information about the customers for the bank itself and for the supervisors. And it's hard to know the real risk. So the danger is treating a solvency crisis as if it was a liquidity problem. But what's more, we're talking about delayed payment of corporate debt. And this is added to the fact that we have already seen corporate defaults in 2020. Here we have an analysis, a pie chart, showing, according to Fitch, for the companies that they evaluate, the composition of corporate defaults in the regions. We can see that in the United States and Canada, that's where we have the largest number of defaulting corporations. It also means that the companies that Fitch evaluates, most of them are in this area. But if we look at the emerging areas, Latin America stands out for having the greatest number of defaults in 2020. So the uncertainty about how many more companies will go bankrupt is making it difficult to get a clear estimate of the true value of banking capital. We may have thought that the situation was strong at the start, but there is no provision being made for these deferred payments, these payment holidays. And this means that the capital could be very impaired, highly impaired. Here we have information about the risks. Obviously, I can't generalize, but we have banks which maintain a large amount of their assets in government securities. Not all banks, but a considerable amount or a considerable number. And here we have to make two comments. First of all, there is a large part of the portfolio in many countries where they have a lot of government securities, and also that foreign investors own a fourth or more of the sovereign securities in local currency. Carmen already mentioned about the uncertainties in the international markets, and she talked about when things come to a halt. And if we just talk about the reduction in investment appetite in emerging markets, this may increase in this time of uncertainty, or it may be for idiosyncratic reasons because of debt sustainability issues. But if for global reasons there is a sustained and drastic sale of government bonds, what happens is that the value of these assets will have a negative impact on the bank balance sheets in several countries. And we have to take into account, what's more, that when we look at the payment calendars, the maturities of public debt, and talking about billions of dollars, there's a kind of leap, or there tends to be a lot of maturities in 2021 and 2022 in the case of Colombia. Chile is a huge difference. 2021 really stands out. And in Mexico, it's higher in 2021. So when there's uncertainty and refinancing of debt, that's when we're seeing more maturities for these debts. This risk with the link between sovereign bonds and or sovereign risk and banking risk was seen in previous crises. In Europe, this is one of the characteristics of the banking crisis after the financial crisis. And in Latin America, well, for example, in Argentina. And with this chart, which we can see, the MB spread, emerging bond market index, shows us that the risk is going up and the holding of government bonds also increases until the crisis comes along. So the riskier the government bonds, the more the banks held. So this increases the fragility of the banking system and weakens their ability to respond to shocks. And so when the devaluation comes along, the whole macro crisis turns into a financial crisis. But this is a point that we must bear in mind. Above all, right now, when countries need more and more refinancing, and this can be affecting the bank system. And lastly, I would say that another factor that we have to take into account, which is very important in Latin America, is political interference, which can revert institutional progress, including the the changes that we're seeing regarding the independence of central banks and financial supervisors. When I talk about the risk of political interference, we have seen cases which go beyond the banks. For example, we have seen a reversion in some countries in the pension funds. In several countries, and we could highlight Peru, the governments have legislated the possibility to withdraw large amounts from the pension funds without offering any alternative for when retirement actually comes along. If we reduce or almost eliminate these savings, which are there for retirement and old age, if we don't establish an alternative, that's the problem, because it really represents going backwards in terms of the development of capital markets in the region. So those are my comments that I wanted to make, and with that I finished. Thank you, Liliana. So now we shall go on to the time for additional comments and questions. I would like to start with Carmen to talk a little bit more about debt. Before, or since before COVID, people were talking a lot about the risks in the world as a whole in different regions due to the increase of government debt and corporate debt. After that, COVID came along and we saw huge increases in debt or borrowing. And we're still in the COVID world, and we are going to no doubt continue to see increases in the amount of borrowing and therefore financial risks associated with the high levels of borrowing in the countries, in the developed world, and in countries with reserve currencies. There's a certain degree of peace of mind because they say, well, the interest rates will be low for a long time. We can grow in small figures, but things will work because interest rates are low, so there won't be big problems. And there may be the same feeling in amongst some people, some economists in emerging economies. They talk about the low interest rates and the liquidity on an international scale. So countries in our region will have access to international markets. We'll see continued capital flows. Sometimes they mentioned the fright that we suffered in March. They said, oh, it was a big fright in March, but that was a shock which came from the United States, which responded very sharply and was contrasted or by the Federal Reserve. And so there's a certain degree of optimism with the idea that since there is high liquidity and low interest rates, and that there will be the possibility for adjustment as time goes by, that this will be able to be done in an orderly way. Carmen, how would you react to this optimism or other extreme views that could, or extreme situations that could arise? Bearing in mind what's happened in Latin America in the past with countries which had unsustainable levels of debt and borrowing, with inflationary processes and financial repression as a response to that kind of situation. So, Carmen, could you perhaps give us your views? Well, imagine that's that's what everybody's asking. It's $1 million question. If we are going to have a faster recovery which would be the more favorable scenario with capital flows. Well, yes, we had a fright in March, April, but look, things have bounced back. That, well, that viewpoint, it's factual. There was a big drop in March, April, and we've had a recovery in the summer, but that recovery, well, first of all, it's been going backwards again since August. Capital flows have been reduced sharply. And this idea or assumption that the change in monetary policy since 1913 is going to be repeated next year or in the next 3 months, well, I don't think that is realistic. In other words, if we talk about push and pull, the push coming from outside and what attracts capital. So if we talk about push, the push coming from abroad, well, that is generated by monetary adjustments. I don't expect the Fed to begin to squeeze at all, but the great push of liquidity, and not just low interest rates, but the establishment of credit facilities, that has had its effect. It calmed things, but it's not going to happen again in 3 months' time or 4 months' time. And it would have to be a really catastrophic situation. So that's the side of the push from outside, and I don't see that happening. And nor do I see that countries in Latin America or other emerging countries will become very attractive in a global situation in which, unlike in 2008, there is no big driving force like China was back then. There's no big driving force to pull the countries out of the crisis, to raise international commodity prices. The oil producing countries are having big problems. We all know that. So I don't see that either. If we talk about attracting capital flows, and there, Liliana illustrated this very well, we are still confusing problems about solvency with, well, a lot of liquidity cannot solve a corporate solvency problem or a governmental solvency problem. I'm not talking about going back to the 80s. I'm not talking about that. But the most difficult, this is the most difficult global situation for emerging countries since the 80s. I do think that, because the problems, well, I went to a conference, I attended a conference a week ago where the argument was, no, look, well, in March, we all thought it was the end of the world, and it wasn't. But you have to remember that Paul Volcker, the chair of the Federal Reserve, well, it was the largest increase in interest rates in 79. And the Latin American countries went into default at the end of the year. And in 1980, it was worse. And 81 was worse than 80. 82 was even worse. And that was when the real crisis began. So there is an accumulative element. Just let me finish by saying that the scenario or the idea that since we have a reserve currency, We don't have to worry about the increase in debt. That's not something that convinces me either. We don't have to worry immediately, but people who use that argument are thinking about a world which existed decades ago in the United States when they had high debt after the Second World War. All they had was public debt. That was all. There was no private debt and there were no pensions. We have to remember that right now, with a much older population, a larger level of pensions, when we have low interest rates, well, it improves the on-balance sheet because it reduces the cost of borrowing, of the portfolio, what you have to pay in terms of interest. But on the other hand, there's a deterioration in the pension funds because they are also depressed. So we have it as better on balance and worse off balance. I'm going to conclude by saying that the distinctions between on balance sheet and off balance sheet is always somewhat fragile. Because after a crisis, often debt becomes public debt. And this is what leads me to my concern, which Liliana referred to, the problem of increased corporate risk, the increased risk in financial institutions, which has consequences for sovereign solvency, because that debt can go from the private sector to the public sector very quickly. We just have to think of Ireland not so long ago. And let me just finish with that. Thank you very much. I shall give the floor to Liliana with regards to comparisons of Latin America with other regions, the impact of COVID in terms of health and economics. Comparisons are made talking about the development of social security systems, the black economy or submerged economy, and the ability to, or the fiscal ability. And these kind of comparisons are made. But in those discussions, nobody seems to talk about, well, maybe some countries, they don't talk perhaps about why some countries respond better or not, and the fact that this is linked to levels of development and the depth of the financial markets. My question, Liliana, is how do you think that the fact that the development and levels are lower and the depth of the financial market is less, how much of an impact do you think that has on the way the countries have been able to respond to COVID? Thank you for that question. Well, the lack of development of the financial market has had an important role, very important role, in the way the impact has been seen on the economy, as well as the response provided by the authorities. We know that when we compare Latin America with, for example, the Asian countries, emerging Asian countries, the degree of financial involvement is very low. Well, there have been programs, but things haven't really changed, and we're talking about very low levels of financial intermediation. If we talk about low savings and, as a result, lack of funds for intermediation, this has obviously increased the impact of COVID on companies and families. With low GDP ratios, many people have had no access to funds during quarantine or lockdown, no kind of funds. There is no savings or precautionary savings available to them or funds available to them when they need them. And this has obviously made it hard for people to maintain quarantine. And this leads to uh, additional infection. So it's a health issue. On the other hand, we should talk about the GDP credit ratios, which is very low, and it shows us that above all SMEs and micro businesses have not had access to bank financing when they needed it the most. And despite the guarantees that have been provided by governments for credits, bank credits, what's happened is that in many countries, the use of these guarantees has been much lower than the offer, what the government was offering, not in all countries, but in many countries. The risk was not offset by government guarantees from the bank's point of view. And another factor is the low development of the financial market. This factor increases the dependence on external financing in the government and the banks. Most of them are in dollars, and often these capital inflows are speculative. All of the problems we've been talking about today with regards the fragility in companies and governments would be less severe if the region had more developed financial markets. Together with this subject, we have to talk about productivity, although I'm not going to go into that. I would just refer to it before finishing, because it's difficult to think that local capital markets can develop if they don't have a wide range of productive projects which will encourage investors to finance projects in the local markets. So with that, I've finished. Thank you very much. I think that since we have you two here, it will be very useful to talk about a particular subject. The director of the International Monetary Fund has expressed concern about the possibility that there may be a withdrawal of tax and monetary incentives, which may be premature. This is something we've seen in a lot of literature which talks about the 30s. And Carmen, I would like you to talk about the criteria that you consider to be appropriate for deciding when it's necessary to withdraw them. I know that the central banks, well, they have objectives and they have a framework which approaches these issues in a systematic way, but not so much the fiscal aspects. So I would like to hear your comments about the criteria that should be taken into account in the governments in order to avoid early withdrawal or late withdrawal of those measures, because that's the big challenge for economic authorities. Well, that is an excellent question. Well, just like all of them, but if we think to the future, the message, well, I wrote an article recently in Foreign Affairs with my husband, which talks or sends out the message that we must not confuse rebound with recovery. And Liliana showed us that as well in the charts about GDP per capita. After this collapse at the start of the second quarter, and where we find ourselves right now, after these falls, obviously we're going to have a rebound, not in production or employment or GDP, but it is a rebound which has not been seen in the past. So there exists the possibility that the governments may begin to say, oh, well, we did that really well. That went really well. And to get ahead of themselves, and they may carry out fiscal or monetary contraction, which would be premature, which could lead to the same errors that were seen during the Great Depression. After a recovery began in the 1933 and 34, then there was a second drop because of that premature approach. So it's very important, just like Liliana showed in her charts, to look at income per GDP and not to think, oh, well, yes, this quarter it went up by 20%. Well, of course, but it had dropped 30 in the previous one. So that's one issue. And the other issue, which unfortunately I can't say much in constructive terms, before I was on leave from Harvard back in the spring, I had an interview and they asked me, during an interview, they asked me, what is it that will push this crisis and recovery? Well, it's the pandemic. So you can't talk about economic healing or financial recovery while you have the pandemic as a huge element of uncertainty affecting all economic activities. Investment is the GDP component which is most affected by uncertainty. So if we see a collapse of the GDP, if that's big, then, well, the collapse in investment is much greater. If we talk about when do we need to make adjustments and take a tighter grip, well, this will be defined by the perception of whether we are out of the reaches of the pandemic. Because otherwise we would just be reinforcing a possible relapse if there was a second wave, such as being seen in Europe, in Spain, for example. And regarding the last part of your question, Jose, although I think that there exists a risk that premature measures could be very harmful, we must remember that some things, they may be persistent, but they have to be considered as transitory or temporary. And for example, in 2008, the Monetary Fund did not encourage Latin American countries and other emerging countries to give tax incentives. If we talk about Brazil, for example, tax incentives. Well, tax incentives were given, but what was meant to be counter-cyclical ended up being permanent, much more difficult to revert or to undo. And so this led to a process in which government spending increased over time. So that's the opposite extreme from what my main fear is, which would be the premature removal of stimuli. And if we talk about the monetary side of things, I see that as being more delicate. Our countries are not used to being able to deal with an adverse shock and do counter-cyclical monetary policies. It's the first time, in truth. The problem that I see is that with this level of uncertainty, as interest rates, domestic interest rates drop and converge with the international rates, foreign involvement of investors has dropped. It's dropped drastically in Brazil and Mexico as well. The reason for carry trade is not the same. If the country needs foreign financing or external financing, I think the lesson is that you have to be very careful to see what balance you want, how low the central bank's interest rate can be in order not to create an exit of capital, as was seen in Turkey. There were capital controls, and the central bank tried to maintain the interest rates at a negative level, and the collapse of the lira has been quite spectacular. In other words, I think that monetary normalization will come before, slightly forced by the international markets. Thank you very much. And another question for Liliana in the same spirit. If we talk about guarantees for bank loans, so the question is how to get out of this system of guarantees. Should we look for and find a different system? What's your opinion about that? Because in your presentation and in your previous answer, you talked about these guarantees. Thank you. Yes. A couple of weeks ago, Andy Powell and myself, we led and published a report from a working group of experts and political advisors in the region. And in that, we showed that public offer, a public supply of guarantees depended greatly on the fiscal space in each country. Chile and Peru had the largest programs, which represent 8% of the GDP. These guarantees have been intended for SMEs, but as I mentioned in my previous speech, the average in the region, well, they haven't been taken by the banks. Up to 50% of those on offer has not been used by the banks, basically because the banks felt the risk of default was very high and it wasn't worth it. In this working group that I mentioned, we were very skeptical about the use of guarantees, and we thought that they are only appropriate for a certain group of companies which are medium-sized with considerable likelihood of being feasible or viable during the pandemic. We constructed a taxonomy to serve as a guide for the policymakers in the use or non-use of guarantees. So, for example, for small companies, informal companies, we felt that guarantees are not the right instrument because there are no incentives for banks to provide credits in a time of huge uncertainty with the pandemic. As Carmen mentioned, the small stores, the little restaurants are going to close and they won't open again because they are no longer feasible or viable. So while there is doubt, what is necessary is help, which doesn't have to be returned, so what we would call a grant. And of course, depending on the fiscal space available. If, however, there are signals that the company is not viable, then they should also be stopped. So instead, monetary transfers should be provided to low-income families who are the owners of these companies. So if you see that you have a very small company and you've helped the company with a grant, but the company is no longer viable, but you want to help, then you should go to the person, the family, by means of a transfer to that family rather than trying to help the company. You forget about helping that company or that business. And for medium-sized companies, the help can continue for a certain amount of time as long as there are no solvency problems. And to be able to take these decisions, to be able to see whether they are solvent or not, it's essential for banks to constantly report on the financial situation of the debtors. You have to be careful which companies get the guarantees because they should only be given to companies which are not highly indebted. You're not going to resolve the problems of a company with a lot of debt by providing them with more debt. That would never lead to good results. Now, if uncertainty about the viability of companies continues, and you don't want excessive debt in the companies, you don't want to give them these guarantees because that's credit, what you can consider, and this is up to the authorities in the region, you can consider capital injections. And people start to tremble when you talk about capital in these kind of spheres. Obviously, it must be done very carefully. Capital injection has an advantage because when the company is doing well, the government wins, comes out winning. But to take this last option, you have to be very, very careful. And so we basically recommend that governments must collaborate, look for the collaboration of international organizations, above all the IFC or the BID, not just for financing, but in order to carry out an analysis of what companies could be candidates for these capital injections, and to be sure that the governance in those companies is appropriate in order for the risk to be worthwhile. In other words, and to conclude, the range of options is large, and it depends on the kind of company, it depends on its financial situation, it depends on its size and the fiscal space of the government in question. Thank you very much. This webinar was organized for 1 hour, and we've already been speaking for a little bit more than an hour, but I can't resist the temptation to give you a few more minutes and to ask a question like an economic journalist. And this is Carmen, what would be your main recommendation to economic authorities in the region in order to preserve financial stability in their countries? So what would your main message be? And the same question for Liliana afterwards, and with that we will finish the webinar. I would say that we have to learn from history. That's important. And there are two particular lessons, which are two versions of the same lesson, which must be taken very seriously. First of all, Japan at the start of the 90s, and the other is Europe in the crisis of 2008. What do they have in common, Japan and Europe? It's an attitude towards cleaning up the portfolios, which is very, very gradual. In other words, well, that's why people started talking about zombie debt, zombie loans, which came out of the Japanese crisis. So it was everything had come to an end, but the credit continued alive. And as I mentioned previously, banks are going to end up or could end up with a portfolio with a high amount of government debt because a lot of debt has been issued and there's a high proportion of non-performing loans. So even though it's painful to be aggressive, I know it's easier to say this than to do it, but to recognize or acknowledge losses and take a haircut, to clean and sort out the balance sheets, and to do this as quickly as possible. This is much healthier when it comes to recovery than leaving it for tomorrow. That gradual approach characterized a lost decade for Japan. In Europe, for example, the crisis was very severe in the US as well. I'm talking about the 2008 real estate crisis, and it was unpleasant with foreclosures. It was not an elegant process, but it was more efficient, which cleaned up the bank's portfolios more quickly compared to how it was done in most of Europe. And that led to capacity for financial institutions to be able to give credit again, which is necessary for recovery. So we need to learn from the Nordic experience more at the start of the 90s, rather than the experience of what we should not do, that of Japan and a large part of Europe in 2008. I would say that's a lesson that needs to be taken seriously. Thank you. Liliana? Yes. I'm sorry, we can't hear Liliana. To avoid that, it's essential that the supervisors make sure that the banks have provisions in line with expected losses. So there are losses which are already expected right now, and their provisions should not stop. And in many countries, this is not being done, and it should be being done already. This means that the capital buffers will drop, because if you provision more, there's less capital. But that doesn't matter. The buffers are there for that purpose, to be used if we need to send a clear message that capital has been reduced. And that doesn't mean that the bank is weaker, but rather it's strengthened because it's recognized its losses and it's it's setting out provisions. That sends a message of strength rather than weakness. And obviously, risk rating agencies are always observing, and it has to be clear that these measures are temporary, and in that situation, we can work with the banks and they can have recapitalization plans for the following months. And lastly, very importantly, in my last slide, I talked about political interference, which could have an impact on these recommendations. It's very important for central banks and supervisors to remain independent. That was something that was gained over the last decade in the region, and that's something we have to look after and protect as if it was pure gold. Thank you very much. Thank you for this webinar. Very special thanks to you both. I think that it's been spectacular, wonderful webinar, and very useful for everybody who has connected and for everybody who may watch it at a later date. This subject was something that was perhaps being left to one side, this discussion about financial fragility. And that's why we decided to talk about it here today with these two experts. And I would repeat again my thanks and thanks to everybody who was connected to the webinar. Thank you to everybody. Thank you. Goodbye. Thank you.